let me take you ahead, and now what we do is we take up a calculative example based on that. That is question number 13. Let us read this question. Suppose we have the following data about a simple economy where they have given C equals to 10 plus 0.75 into YD, I equals to 50, G equals to T which is equal to 20, where C is consumption, I is investment, YD is disposable income, G is government expenditure and T is tax. Actually speaking, we don't even want all these details, right? We understand all these variables already. Find out the equilibrium level of national income and what is the size of the multiplier. Because they have demanded the size of the multiplier, we will compute that size of the multiplier anyway. So let us do that. Since G equals to T, budget of government is balanced, and Y equals to C plus I plus G, where Y indicates national income and C indicates consumption, which is A plus B into YD, and that will be 10 plus 0.75 into YD, and I is investment, that is given as 50, and G is government expenditure given as 20, T is tax which is given as 20, and when you try to determine YD, don't forget YD itself is basically Y minus T. So substituting all these values, what we get is the substitution of YD as Y minus T, that is the income minus tax, that will make it disposable income. So we don't know Y, but we can just write Y minus T. T is 20, so we can substitute that for Y minus 20, and then when you solve this whole part, you get the value of Y easily without any trouble. And here we get 0.25 Y equals to 65. So Y will be 65 divided by 0.25, that will be 260. So the equilibrium value of Y will be 260. Let us move ahead. Because the question has specifically asked the computation of the multiplier, we have to do that. So multiplier, that is K equals to 1 upon 1 minus marginal propensity to consume, and I don't have to explain you this. I have been explaining this kind of calculation all the way through, and when you substitute these values, the value of B was 0.75. So 1 divided by 1 minus 0.75 will be actually the inverse of 0.25. 0.25 will be the marginal propensity to save, and multiplier is just inverse of that. So now you compute the multiplier by taking 1 divided by 1 minus B as 1 divided by 1 minus 0.75, or you may take it as 1 divided by 0.25 directly, doesn't matter. Eventually you will get the multiplier as 4 times. Let us move ahead and we deal with the second part, that is income determination with lump sum tax and transfer payments. Let me explain this point to you. You will understand this very easily, very easily. Just try to concentrate on one thing. Earlier we had lump sum tax only. Now there is lump sum tax as well as transfer payments. Now use your simple common sense. Suppose you are earning 100 rupees and I am government, I collected rupees 20 from you as tax. So the disposable personal income in your hand remains only 80, but now I am making a transfer payment of rupees 5. So what you will do? You will count your disposable income or disposable personal income as 100 minus 20 that you paid as tax, but you will add rupees 5 which I am giving you as transfer payments. So wherever tax was subtracted, over there the transfer payment will be added, and wherever tax was added, the transfer payment will be subtracted. In other words, the transfer payment will be having opposite effect of tax. That is the only difference over here. Otherwise, if you have understood the first part, this part is extremely simple again. So let us just write up the notes about this. Over here you write the consumption function is defined as C equals to A plus B into YD. where YD, this time YD will be Y minus T plus TR, correct? From your total income, you are subtracting tax and adding transfer payments. So YD will be Y minus T plus TR. That's all. So Y is your income, T is the lump sum tax, and TR is the autonomous transfer payments. So the equation goes this way: C equals to A plus B into, instead of YD, I am writing Y minus T plus TR. Let us move ahead and continue writing further. Y equals to C plus I plus G, that is equation number 1. Now we substitute the value of C in this equation. So this time we will get C's value as A plus B into YD. The YD is basically the disposable income. But how do we determine YD over here? It is Y minus T plus TR. So now when I am going to open this bracket, B gets multiplied to all the terms. BY, I shift to the left hand side and I get Y minus BY equals to A minus B into T plus B into TR plus I plus G. So basically Y taken common in the left hand side, Y into 1 minus B will be the right hand side of the equation. So value of Y will be 1 divided by 1 minus B into A minus BT plus BTR plus I plus G. Look at just one thing, guys, look at just one thing. In the previous version, this term was missing, right? Only what was there in this bracket, A minus BT plus I plus G. This was missing because there were no transfer payments. So here transfer payments have been brought into picture. That's all you have to understand. Let us move ahead and we take up a calculative example given in question number 14. Let us read this. Suppose the structural model of an economy is given as C equals to 100 plus 0.75 YD and I is 200, G equals to T and that is equal to 100 and TR equals to 50. Find the equilibrium level of income. So this question and previous question that you solved, this just have one new component over here, right? That is the transfer payment. And I told you, whatever effect you are giving on taxation, just give the opposite effect on transfer payment. So what is to be done? I am not going to explain you the whole thing again. You have solved this kind of question already. The new component over here is basically the transfer payment. So T stands for tax and autonomous transfer payments will be 50. So when you compute YD, it will be Y minus T plus TR. So Y minus 100 plus 50. So investment is given as 200 and government expenditure is given as 100. Let us move ahead and we continue writing further. Y equals to C plus I plus G. Substitute all the values over here and when you do that, YD value we have already ascertained as Y minus 100 plus 50. So when you substitute all of these components, you get the whole equation in a single variable, that is Y, and when you solve it, you will be getting the value of Y directly. So you can do the solution through this approach or the formula based approach which I have given you some time back. So where Y formula was given, if you substitute all the values as per that formula, you will directly get the value of Y as 1450. Let us move ahead and deal with the third situation now. Here the tax function is defined little differently. So total tax is T plus T into Y. So let me explain this point to you. It is actually very simple. You know, there will be one lump sum amount of tax which the government will be collecting from the entities. You know, concept of minimum alternate tax exists, where whether the company is earning some profit or not, they will have to still pay some amount of tax even if they don't earn any profit. That is what we call as minimum alternate tax. So basically some amount of tax government will collect as a lump sum payment, and the remaining part of the tax they will be collecting as a certain percentage of the total income. That means there will be two different components of tax, fixed tax and variable tax. So in the first situation we have learned only lump sum amount of tax, that was fixed amount of tax. Tax was not dependent on income. Here we are considering both the types of tax, fixed tax and variable tax. Variable tax will be a function of the income, and where tax rate gets multiplied to income, that component will become the variable tax, and the lump sum amount of tax will be fixed tax, aggregate of that will be total tax. Once you understand this much, you just have to determine YD. YD is what? Disposable personal income, or simply disposable income. How would you do that? It is basically capital Y minus the total amount of tax, correct? Capital Y minus capital T, that is the disposable income. But this time T will be itself aggregate of two types of tax, the fixed tax and variable tax. So separately compute the fixed tax and variable tax, sum it up, and that you subtract from income, and that you get as the disposable income. So that's all in this third situation. I'm sure you will easily follow this when I put it forward over here. So Y is the income, T is the income tax rate. This small t is defined as the income tax rate, capital T is the total amount of tax, and this T is the autonomous constant tax as T bar. So T bar is the autonomous constant tax, and this small t is the tax rate which is dependent on the income. So tax rate multiplied on the income will give you the variable portion of the tax. T bar over here will indicate the autonomous constant tax or the fixed amount of tax, and the capital T over here will be the total amount of tax. Let us move ahead and write up further. That will be derivation of an important formula over here. So we know that the consumption function will be C equals to A plus B into YD. YD over here indicates the disposable income, you know it, and under this model the value of YD will be capital Y, that represents income, minus T bar, that is the autonomous constant tax, minus T into Y, where this part of the tax is a certain percentage of income which will be payable as tax. So this small t is that tax rate and Y is the income. So this is the variable component of tax, this is the fixed component of tax. Both taken together will be the total amount of tax. That subtracted from the income will eventually give you disposable income. So when you substitute the value of disposable income, that is YD, in the consumption function, this is what you get. And now what we will do is, we know one more thing, that Y equals to C plus I plus G. That will be considered as the main equation now, and now we substitute the value of C in this equation of Y. That means in this first equation we are substituting this value of C. So what we get, Y equals to A plus B into Y minus T bar minus Ty within brackets plus I plus G. So this plus I plus G remains as it is. This C has been substituted for this whole term, and now what we get, when we open the brackets, A remains A, B into Y, By, B into minus T bar minus B into T bar, and B into minus Ty will give you minus Bty, and plus I and plus G remaining as it is. Now what we will do, terms with Y in the right hand side, that is this By and minus Bty, both of these terms will be shifting to the left hand side. So By, because it is a term with the variable Y, and the other term Bty, both of these terms will be shifted to the left hand side. So the term with a plus sign will become minus, the term with the minus sign will become plus. So we get y minus by plus bty equals to a minus bt bar plus I plus g. When you observe the left hand side of the equation, y could be taken as common. So you take y as common and you get within brackets 1 minus b plus bt, and here you get the right hand side as it is, a minus b into t bar plus I plus g. Now if I have to find the value of y, what will I simply do is I will shift this whole thing to the left hand side, and if I can observe one more point, here the second term and third term, both of these terms have b as common, so I can take one more step over here, that will be y into 1 as it is. I have taken minus b as common, so minus b into 1 will give you minus b, and minus b into minus t will give you plus bt. So I am sure you understand the changeover from this line to this line. Right hand side I don't have to explain, it remains as it is. Now what we do is, in the next line, this y value will be obtained and this whole term will be taken over here as a denominator. Let us move ahead and now write up that last line. So y will be equal to 1 upon 1 minus b into 1 minus t, and that will be multiplied to a minus b into t bar plus I plus g. So actually speaking, in this term you are multiplying this factor to obtain the value of y. So obviously we will be considering this as the multiplier. Logically, when the variable component of taxation was not there, we have taken the multiplier as 1 upon 1 minus b. You know it very well, correct? The multiplier generally is obtained as 1 divided by 1 minus marginal propensity to consume, and 1 minus marginal propensity to consume will actually give you marginal propensity to save. So 1 minus b had been marginal propensity to save. Can you notice one thing? To this b we are multiplying 1 minus t. That means what is happening? You are giving a post tax effect to this b and then subtracting it from 1, and what you get over here as a multiplier, this multiplier will be with a post tax effect, because certain portion of income is payable as variable tax over here. Let us move ahead and we take up a calculative example given in question number 15. Let us read this question. For a closed economy, the following data is given. Consumption C is given as 75 plus 0.5 into y minus t. Investment I is given as 80. Total tax T is given as 25 plus 0.1 y. Now this line clarifies that one portion of the tax is the autonomous constant tax and one portion of tax is dependent on the income, that is the variable portion of the tax, and government expenditure G is given as 100. Find out equilibrium income, that means they want you to find the value of y, and secondly, what is the value of the multiplier. I have explained you just a moment back that multiplier over here will be having that post tax effect. So let us do one thing, let us systematically write up the solution of this particular question. So please carefully note down the main equation, y equals to c plus I plus g. Define all the variables. Y is the national income, C is the consumption, and we have given the consumption value as A plus B into y minus t. And when we substitute this, notice one thing, value of A was 75, B was 0.5, and within brackets we have taken y minus t, and the t was compound tax, where it was having one component as the autonomous constant tax, that was 25, and the other portion of tax is dependent on income. It was basically 10% of income, or simply 0.1 y. So 0.1 y as well as 25 both subtracted from y will give you the y minus t effect, which will become disposable income. B multiplied to that will give you the later part of this equation, and A is a constant which has value of 75. When you solve this equation along with other variables defined as investment as 80 and government expenditure as 100, you get this entire form of equation. And notice one thing, now we have a single equation with just one single variable. Solving this equation, I literally don't have to explain you anything. Mathematically how to solve equation, you know it very well. My role over here majorly is to explain you the formulation of an equation. Solution of that equation is in your hand. So value of y, what we are getting is 242.5 divided by 0.55, and that gives you 440.91. Let us move ahead and write up the later part. Here we have to compute the multiplier. So multiplier in this kind of situation, we have just learnt it will be 1 divided by 1 minus b and b into 1 minus t. So minded, it is not 1 minus b within brackets into 1 minus t, it is just b multiplied by 1 minus t, and that whole thing should be subtracted from 1, and that will give you the value of multiplier. So we may define the variables over here, and you know one thing, you can solve the question even by using this multiplier concept. I am going to do that for you as well at the later part of this whole thing. So this is the multiplier, and when we determine the value by substituting all the values of these variables and constants, what we are getting over here is 1 divided by 1 minus 0.5 into this portion. So obviously because 1 minus t is within brackets, first you have to solve this. So 1 minus t will be 1 minus 0.1. You should not forget that this small t is a tax rate. So 0.1 indicates 10%. So 1 minus 0.1 will give you 0.9. 0.9 should first be multiplied to 0.5, and that will give you 0.5 into 0.9, that will be 0.45. So finally the value of multiplier comes this way, 1 divided by 1 minus 0.45, which will be 1 divided by 0.55, and what you get as multiplier will be 1.82. So multiplier value is 1 upon 0.55, and when you calculate it, it is 1.82. Write up this part of the solution, and then I am going to show you alternate way of presenting the whole solution, that first you compute the multiplier and then you substitute the value of the multiplier directly and find the value of y that represents national income. Let us move ahead. And now what we do is we go with an alternative way of solving the question, which could be so much straight and clear way. Just observe this. In the formula, we have derived this as the final version of the formula, correct? And when you observe, we have all the values available. Actually speaking, this part is the multiplier. So we have already dealt with the multiplier part. But if I substitute all the values individually, 1 minus b into 1 minus t over here, and 1 divided by that whole thing will give you the multiplier. That multiplier should be multiplied to this whole term. A was 75, b into t bar we have obtained as 12.5 with a minus sign, I and g were given in the question. If I am solving this part, you know this is going to be 1 divided by 0.55. I have shown you that already. Individually, if you want, you may again try calculating it. 1 minus 0.1 will give you 0.9. 0.9 into 0.5 will give you 0.45, and 1 minus 0.45 will eventually give you 0.55. So the multiplier effect is basically 1 divided by 0.55, and this whole term works out to be 242.5. So do you know y value is simply multiplier into 242.5, and 242.5 when multiplied to this multiplier, obviously you are going to get the same amount of national income what we have computed in the original solution. So it is okay that you can present the solution this way also in examination. Of course, one thing you will have to do is define all the variables, which we haven't defined over here because I have already shown you the definition of all the variables in the earlier slides. Let us move ahead, and now we deal with the last possibility over here, that is income determination with tax as a function of income, government expenditure and transfer payments. So basically we are now including transfer payments also. When you include transfer payments, what will be the impact of this? Let me explain what exactly I mean. There will be some lump sum amount of tax, that is T bar. the fixed component of tax, autonomous tax, minimum amount of tax that will be paid irrespective of anything. So that will be T bar. Another component of tax, that is variable tax, that is small t into capital Y, that will be another component of tax, and along with that there will be transfer payments also. Now you tell me, use your common sense and tell me, how will you determine the disposable income? It's all about determining disposable income. So capital Y, which indicates the total income, take that capital Y, total income, minus the autonomous constant tax, minus the tax which is dependent on income, and add the transfer payments. Transfer payments will have opposite effect of tax, and both the taxes will be dealt with together. So let me give you note on this. C equals to A plus B into YD. Now what was YD over here? Y minus T minus TY plus TR. So you know Y equals to C plus I plus G, that is the first equation, and by substituting the value of C in equation 1, we get this time Y equals to A plus B and B into Y minus T bar. T bar is the constant tax, minus T into Y and plus TR. T into Y is the variable portion of tax, TR is the transfer payment, plus I plus G. So everything remains as it is. If you just use your simple common sense, you will be understanding the whole derivation over here. B into Y shifted to left hand side as we generally do always. This time B into T into Y also shifted to the left hand side. So left hand side will be getting Y minus B into Y plus B into T into Y, and then what we get in the right hand side is A minus B into T bar plus B into TR plus I plus G. Now carefully observe this particular term. Here you have B with minus sign and plus BT over here. So if I take minus B as common from these two terms, do you know what I will get? Y into this one remains as it is, minus B taken as common, so minus B into 1 will give you minus B, and from plus BT, if you have taken minus B as common, what remains is minus T, because minus B into minus T will give you plus BT. The right hand side remains as it is without any change. In fact, this is something that I have explained you earlier as well. Now obviously without me saying anything further, you would have figured out that if we want the value of Y, what we need to do is this whole thing should be shifted to the right hand side as a denominator, and actually speaking inverse of this whole term will become multiplier. So what I am going to write now, 1 upon 1 minus B into 1 minus T as the multiplier, which will get multiplied to this whole term, and you will be getting Y as the final outcome. So let me show you that line, and you just write down this whole thing. I have explained you this already. If somebody is asking you to compute the multiplier, this will be the multiplier, which is 1 minus B into 1 minus T, and again I am telling you, it is not 1 minus B the whole thing within brackets, huh? This is only B multiplied by 1 minus T, and the whole thing should be then subtracted from 1. This is how you should solve the equation whenever you are applying this particular formula. Let us move ahead and learn how to apply this in question number 16. Let us read this question. They have given over here C equals to 100 plus 0.8 into Y minus T plus TR, and T itself is given as 25 plus 0.1 Y. That means in this case all three components are present. The autonomous constant tax is present, the variable amount of tax is present, and transfer payment also present. And then once you apply this Y minus T plus TR, you will get the disposable income, that multiplied to the marginal propensity to consume, that is B into YD added to A, you will get the consumption function. And they have simply asked you the value of Y because they have asked you the equilibrium level of income. How to solve it? Very simple. I don't have to explain you this part, you know it very well. Once you have understood the things conceptually, you just need to write up the solution by substituting the correct values. And when you are solving this question, look at one thing, how we have expanded T. T was autonomous tax plus the variable tax. So don't forget, both of these aggregated will become T, but T was with minus sign. So both of these components will also be with minus sign. You just have to solve this equation, and what you get as value of y will be 420 divided by 0.28, that is 1500. That will be end of this solution. So please take note of this. That will be end of this solution as well as end of this particular session as well.